Put $25,000 into a savings account, paying 0.39% for 1 year, and the annual interest is about $97.50 before tax. That is not a monthly figure. It is the modeled total for the year. The rate comes from the FDIC's National Savings Rate Table, published March 16, 2026. It is a deposit-weighted national measure, not a claim about your bank, and not a quote you can automatically obtain. But it gives us a useful receipt. A savings balance can look substantial while its yield is almost invisible. In this episode, we will turn the percentage into dollars, test the trade-offs, and build a cash audit you can run from your own statement. The calculation also scales. At this same rate, $10,000 produces $39 over a year. $50,000 produces $195. Those are simple estimates before tax, not account statements. Scaling the balance makes the percentage easier to feel, but it does not change the first task: confirm the rate that actually applies today. APY means annual percentage yield. It is designed to express a 1-year yield with compounding included. For a quick estimate, multiply the balance by the APY, written as a decimal. 25,000 times 0.0039 equals $97.50. That shortcut assumes the balance and rate do not change. Real accounts may calculate interest daily, credit it monthly, use balance tiers, charge fees, or change a variable rate after you open the account. A headline APY can also have conditions. So do not compare accounts using the biggest number on a marketing page. Compare the APY that applies to your balance, the expected dollars after fees, how quickly you can access the cash, and whether the account is actually an insured deposit. A PY is not the same as APR, and it is not the same as a promotional headline that disappears after a few months. A PY helps compare deposit yield on a standardized annual basis. Your net result still depends on whether a monthly charge, required linked account, or minimum balance rule applies. Convert every condition into annual dollars before deciding that one percentage is better. Here's the official snapshot. The FDIC table showed a national savings rate of 0.39%, interest checking at 0.07%, and money market deposit accounts at 0.56%. On the same page, the Treasury yield reference used in the rate cap calculation was 3.64% for non-maturity deposits. That does not mean a savings account and a Treasury bill are interchangeable. It shows that the surrounding short-term rate environment can be far above the rate reaching a standard deposit account. Deposit pricing is not one national menu. Institutions compete differently, customer balances behave differently, and account features differ. The useful question is narrower. What rate is your cash receiving, and what are you giving up to receive it? Because the FDIC national rate is weighted by institutions' shares of domestic deposits, it describes where a large volume of money is priced. It is not the simple midpoint between the highest and lowest offers. A single national figure can coexist with a wide range of account rates. That is precisely why a personal statement audit is more useful than assuming the national number is your number. Now hold the balance constant and change only the yield. At 0.39%, $25,000 produces $97.50 in a year. At an illustrative 3.5%, the same balance produces $875. The model difference is $777.50 before tax. That is opportunity cost, the difference between this choice and a defined alternative. It is not a guaranteed loss, because a higher yield option may have different access, eligibility, insurance, rate change, or administrative features. The right comparison preserves the job of the money. Emergency cash needs reliability and access. Money needed on a specific date cannot be evaluated like long-term investments. The case file is not telling you to chase yield. It is telling you to make the trade-off visible. Run the comparison at several balances. At $5,000, the modeled gap is much smaller in dollars. At $100,000, it is much larger. The percentage difference stays the same, but the practical importance changes. Then, ask how long the cash will sit there. A 1-month parking place and a multi-year reserve should not be judged with the same annual dollar assumption unless the rate is expected to persist. Yield is only one line. Next is protection. The standard FDIC insurance amount is generally $250,000 per depositor per insured bank for each account ownership category. Ownership rules matter, so use the FDIC's estimator for anything complex. Then test access. Can you transfer today? Is there a settlement delay, withdrawal limit, maturity date, or early withdrawal penalty? Treasury bills, for example, are short-term government securities sold at auction. They are not bank deposits, and selling before maturity introduces a market transaction. Their interest is generally subject to federal tax, but not state or local income tax. Verify your own tax treatment. Finally, test conditions: minimum balance, promotional window, membership requirement, transfer limit, and fees. A higher rate can still produce a weak result if the account adds friction or charges that consume the interest. Also, check where the deposit legally sits. A financial app may place customer cash at one or more partner banks, and the app itself may not be the insured institution. Coverage depends on record keeping, ownership category, and balances held at the same insured bank through every channel. Read the disclosure, identify the actual bank, and include any accounts you already hold there when assessing coverage. Run this 6-line audit. 1. The exact APY applying to your current balance. 2. Estimated annual interest in dollars. 3. Monthly fees and waiver conditions. 4. Transfer and withdrawal access. 5. Deposit insurance status and ownership category. 6. The best comparable option that still performs the same job. For rate-sensitive numbers, record the date. A comparison without an as-of date becomes stale evidence. Recheck the figures before moving money, and never assume that a platform's brand name means the underlying cash is held in the way you expect. Put the audit on a calendar. A variable savings rate can fall without the balance moving, while a promotional rate can expire. Review the statement at least quarterly, and whenever the Federal Reserve rate environment changes materially. The objective is not constant account switching. It is to prevent an old default from quietly becoming an expensive default, while the purpose of the cash remains unchanged. The verdict is simple. Safety and convenience have value, but a low yield has a dollar price. Your job is to see the price and decide whether the trade-off is deliberate. Next, we turn the balance sheet around and ask what the bank earns while deposits help fund the institution.